Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show, we do a deep dive into different industries using weekly charts to see what is happening on a long time frame. Please follow me on Twitter at Schnell Investor, and you can also find my blogs at gregschnell.com as well as StockCharts.com. So the main problem with the bull market is uphill, and right now we're feeling it's very uphill. Markets are still falling today again, so I think we're 3 days now that we've had 1,000-point days. So things are moving down very quickly. I saw a tweet on Monday, and when we had lost 1,000 points, and somebody said, you know, in 28 days we'll be at zero. It's not so funny now when all of a sudden it is 1,000 points a day, and we keep doing them over and over. So it's a global breakdown. I want to cover that off a little bit, but I do want to show how all of our advanced decline indicators and stuff are at really significant extremes. And then we're going to review some of the S&P 500 stocks just to kind of go through what's working and keep that up. I did mention on Wednesday that I would cover off looking for new investing opportunities. I think at this point, we're still a little early to start jumping into things. Things are still breaking down around us. And what I'd like to make sure of is that people understand kind of the bigger, broader implications of the market picture. And for my subscribers, I'll be covering off that in a major way this weekend. But the main point of the Market Buzz to just give you a feel of where we're at. And so we have a VIX over 50. That's really high. We've had some VIX spikes up into the 90s, I think was one, but for the most part above 36 is pretty radical. So we're kind of already there. I think the real question is, you know, as we bounce out of here, when we bounce out of here, maybe that's another 1,000 points lower. I don't know. But what we're watching for obviously is these extreme selling pressures to ease. But I think the real question will be, on the bounce, how much momentum do we get? And so that's one of the big things to watch for here. So we have the PPO trending down here. This is pretty significant momentum drop. We're down quite far here. You could just see in the 7 days, we were up at 9,800 on the Nasdaq composite. We're under 8,400 today. So pretty significant drop. And then IWM is already at 52-week lows when you use the small cap index. So there's lots going on there. Canadian market following along. And even if we go to most of the commodities, they're all falling as well. So here's natural gas drilling in the bottom corner. Oil down 5% today. Gold is getting hammered again today. So in terms of a move to safety, that didn't really happen. And TLT turning up. I think, you know, eventually that move starts to get overbought or oversold or whatever you're thinking, depending on you're talking yields or price. But I think the big issue that we want to watch for on the bonds is any sort of a reversal. And again, I would start to expect some verbal traffic from the Fed, even if it's no action, just to stop the pile on selling. So we'll keep watching that situation. The US dollar has been declining all week with the markets, which is really interesting because I'm trying to figure out what market they might like better. Now, when we look at the large caps, this is a chart I don't go to very often, but I think it's helpful today. And what I want to show you on this is a monthly chart. And what I've done is I've got the Bollinger Bands, and nothing more than that, just the Bollinger Bands. And what I like to look for here is when the market starts to dip below the 20-month moving average, and obviously today's the last day of the month, so we're going to close very close to that on the S&P 500. You can see back in here we've bounced off that level multiple times, and only in late 2018 did we dip below it. When we go back to 2015, obviously there were bigger pushes down in through that level, and we stayed down there for almost 6 months before being able to fight our way back out of the hole. So when we scroll down, just maybe shrink this down again. When we scroll down here, this is, oh, I'm on one page too many. Let me just go to this one first. So on here, I've got the S&P, and you can see we're right there. If I go look at the Nasdaq Composite, we still have quite a bit of room to get down to the 20-month moving average, and that's around 8,000. So that's another 300 points lower from here, or about 5%. Here's IWM, and you can see on this we're already down through the 20-month moving average, and we're still trying to hold here. But if we use just the weekly close of the small cap index, this takes into absolute lows. We're pretty much at a place where we'd expect the market to try and rally off of this level. If not, we're that's pretty major support. If all of a sudden we start to break through that, then we're down into a much deeper dive. Looking at the Dow Jones Industrial, we're already, those are 30 mega cap stocks, and we're already well through that support level and very close to new 52-week lows for the Dow. So that's probably, if we're going to bounce anywhere, this is probably a pretty good place to look. And looking at the TSX, the Canadian market, we're thrusting down through the 20-month moving average as well. And so what we see here is not quite at 52-week lows, but on Monday we would be, because then we'd be on the third bar over here. So we're very low so far, but still in around the area where we might expect some support to come in. Here's the Nikkei sitting right on the 20-month moving average. Now, the problem is this isn't updated for the Carnage overnight. So they're going to close down here another 4% lower. So that one's clearly a move into negative territory. When we look at Australia, it's obviously going to be down as well, but I think it'll hold up above its 20-month moving average for the close of February. The Shanghai Composite, obviously, that market isn't allowed to free float. And so what we're seeing here is they're actually up on the month, considering all of what's gone on in February. I think by any standard, we'd call that amazing. Hong Kong, we're sitting below the 20-month moving average, and we're sitting right down in the bottom of this congestion zone. And if that was to start to break out to the upside, or break out to the downside, that would be a bigger factor. But we are below the 20-month already, and so we'll just see how that continues to trade. Of course, they were weak before with all of the protests there. So adding on the virus issues, COVID-19, if you add those on top of what they were experiencing, they're really going to struggle here with their economy for a bit. And here's Russia. Russia's still well up near the top of the range, probably one of the strongest markets relative to its own 20-month moving average, but starting to break through the big uptrend that they had going as well. And then looking through on the next chart, here's, so I've already covered off the S&P 500. Here is the UK ETF, and I've just used a hedged version of it here. It gives us a real-time price, but what we see is this is already moved to the bottom of the 20-month moving, or of the monthly range for the Bollinger Band. So you've got 2 standard deviations up and 2 standard deviations down, and in really from middle of January to now, we've moved 4 standard deviations. So it's been pretty significant move, and we're very clearly banging on the bottom here. So one of the things that I don't think is getting credit right now is Brexit is obviously, it just happened at the end of January. There was a bit of a rally, and you can see we've moved down significantly. But when we go look at Germany, it's going to close down here closer to 12,000, I think. So with that, it's going to close below its 20-month moving average after making a double top here, which is a pretty big deal. And then when we get into the French market, it broke the big downtrend that had been going on here. We're back above the breakout level from 2019, and all of a sudden it went on a surge. We're going to close just under the 20-month moving average there as well. So here's Spain. We're below the 20-month moving average and getting down towards the bottom of the Bollinger Bands already. And the reason I just picked Spain and Germany and places like that, they all have 60 million people. I don't have the Italian one on here, I don't think. So here's South Korea, and what you see is, again, they're rolling over pretty hard. They have some support down here at 1900, would be about another 10% below that, but you could see that would be like 5 or 6 year lows, so pretty important place for them. India is still one of the stronger markets in the world, pointing up towards the top here, and obviously it'll have a down candle, but should still finish in the top half of the monthly. And here's Brazil, huge uptrend off the 2016 low, but this month clearly reversing. And I would say that the uptrend that if we drew it on a weekly chart or whatever is clearly broken. So you're starting to see all the commodity countries break down. And then we have Indonesia right at the bottom here, where it's very close to breaking to new 2 or 3 year lows. So they've got floods and they've got other issues going on there as well. But big issues around the world. And so the point I want to make just by looking at these 20-month moving averages is really when we're above it, that's a pretty solid place to expect to stay above it. When we start to go below it, you either want it to bounce off it as support or be very aware of the trend change that all of a sudden everything is starting to break down. And when, as a group, they all start to go, that's a big problem. So we're going to close the end of February on that moving average for most of the markets. I think the comp Q probably won't, but everything else will be right down at the bottom. So with that, I want to kind of frame that as a larger discussion that we, when you go below the 20-month moving average, that can be more severe. So I don't think it's time to start cherry picking stocks just yet. I did want to point out this bank index ETF. I pointed it out on Twitter this morning that it was, before the open, it was trying to hold this level, but it is now breaking the 10-year uptrend. And, nobody expects a problem in the banks. I think that's fair. What we're more worried about are problems in places like China, where their banking system was already under stress. And then all of a sudden, if that starts to break down, that creates more slippage in the global economy. And we've got some other places that have bank issues as well. So global economy, if all of a sudden you start to see bank stress, this is where it's going to start to show up, is on some of these charts. Now, one of the concerns, I think that's probably a fair way to word it. One of the concerns about the global economy is when you're having, I'm trying to talk and find the chart I'm looking for, the broker dealers here. What we see here is this broker dealer is trying to hold this uptrend off 2012, so it's not the 2009 low. But what we're hoping to see here is obviously that these start to hold up, but they have just rolled over in momentum. So there's lots of room that they could fall to the downside. And again, what you notice is it was kind of 4 years between touches here, then 3 years, now 1 year, and now 6 months. All of a sudden, we're starting to shrink the time frame that everything's keeps retesting these levels. And again, so lower bounces and less time between the bounces. So usually that means we start to break down. Now, the real question that we have is, as we move forward here, are there areas of safety? And I would just say that, it doesn't matter if you're in consumer product companies, they're falling. Utilities are falling. They may fall less than the overall market. They're definitely falling less than tech. But the real question is, your portfolio is still going down, even if you were in those safe havens. So this is the big picture for semiconductors, and I think it's a pretty important one. But what I want to mention here is, if semiconductors are going to start to break down, they still have lots of room to go. They're at about 37.50. They could go all the way down to 32.50 before checking this 10-year uptrend. So with that, we're going to take a quick commercial break. The commercial's about chips, deep dive, and this weekend it's going to be about the advanced charting platform. So take a listen real quick, and we'll be back shortly. Okay, we're back, and the chart I've got on my screen now, we're going to talk about the advanced decline line. I covered this off last week, but I think what's important is just to understand how different people use them. To me, I think the trend lines on the advanced decline line are a pretty important deal. But I do want to point out one thing here. So here we have, this is the Nasdaq composite up top, and we had the short trend line off the October lows, and we clearly broke through that early in the week. And then by Wednesday, we were testing this bigger slope off the 2018 low. And now we've got an even lower slope that we're testing, which is kind of the most recent lows as we um, kind of paused through the summer of 2018. And then in October, we fired it up. So we're sitting right on that trend line right now. And perhaps that's a place the market could try and bounce here from. And again, everything is oversold. So this um, gauge here in the middle for the moving average, this is a 2-week moving average of the advanced decline line. And again, you can see down in December 2018, we got down to this severely oversold level. And that was kind of an area from which to bounce from. So in terms of sentiment, we are there. That doesn't mean the market can't make new lows in sentiment or whatever. But all of these things, like look at the red paint that we've got going on here. You know, the market, I call it redder than Margaret's lipstick. But this is literally, we are down banging on the lows here. And in December, we had many days in December where we were pushing down pretty hard. The big problem we've got here, obviously, is it looks like we've just gotten started. I mean, we just came off the highs just a few days ago. So we have now broken the uptrend off the 2018 low in the advanced decline line. I think that's a pretty big deal. And we also had this shorter one that didn't take the October low into effect, but you could see the trend line was there. So when I widen out this chart, you know, how severe are we? Okay, well, since the financial crisis, there's only been one dip this low, and that was the December 26th drop. And then all of a sudden we rallied 1,000 points out of that hole on that day. And you could see, you know, this was a 20% drop. We're already down roughly 15%. We're sitting right on this low down here. And as the market tries to price in or evaluate the size of the pullback here, all things are starting to lead that we're at some sort of an extreme, and whether we get a bounce out of here, that would obviously not be a surprise just because we're so oversold. But I think it's important to recognize how extreme we are. We're at, you know, one of the most extreme readings in 10 years. And if we open this up to 20 years, and again, this is just taking a 2-week moving average of the advanced decline line. There was one in 2008, one in 2001, which was probably the 9/11 event. And then we had the one right after the tech market started to crash in 2000. So this is the Nasdaq market. So, you know, we're in rare air here in terms of downside pressure. And so it wouldn't surprise me that we start to rally out of the hole. Looking at the Nasdaq high-low, again, we're down at deeper levels. And, you know, one of the things I would like to focus on, you know, when you see a chart and you're at the bottom 5% of the dips or whatever, you know, this is as difficult as it is. This is an important place on the chart for us from a technical perspective, but it could just be the first initial thrust down. And like in 2018, that's what we got. We got a thrust down to this level, bounced all the way back up, started to try and look good, and then fell away again. So really important to keep an eye on it, but we're definitely deep enough to be an initial thrust where we're still worried. And so any bounces that we get here should be swift. But the other thing that they should be is you know, make sure you've got your stops in as you go up, so that if you wanted to get out, there'd be a better opportunity at higher prices, I think. So the first one was the Nasdaq composite. This is the New York composite. And again, we're below the New York composite level from December. We've broken the uptrend line on the advanced decline line for that. And we've broken the uptrend line on the New York composite. And we're at 52-week lows now for the New York composite. So that's very quick from 52-week highs to 52-week lows. That's a pretty major reversal. Same thing, let's do the high lows on that page. But this chart, look at how the 2-week moving average has hardly moved so far. It was just so quick. And then down here we have the high low individual readings, and we're down at one of the most, you know, significant pullbacks in the history of the chart, going back 10 years here. I would say that the one thing I notice about this chart is it tends to get double dips. And, you know, the varying time frame around them. 2018, we got down to this level, and that was kind of, we just hovered there for a long time. And you can see the red chart up here That's the actual price of the index. But look at how oversold it got in December 2019. Well, we're right up here. We're barely making a blip on the page so far, just because it's looking for a 2-week moving average. Then here we are, way down here. And the problem is on this, again, you're at such an extreme level, I would expect some sort of thrust out of here. The question is it a double where we end up bouncing out and moving on? So I'm going to just show you the three percentage indicators. This is for the 1500, the S&P 500, or the S&P 1500. And we're at extreme levels again, way down here. And we're also got this big uptrend off the 2019 low that's been broken, and that was before today. And then we're very close on this index here to breaking to, well, not quite 52-week lows, but definitely back to the lows of October when we started this rally. Looking at the mid caps, what we see here is a very big breakdown. The mid caps are now below and into a 52-week low, and the uptrend has been broken on the advanced decline line. So also dangerous. And then what we see here is the, just using this moving average again, we're at very severe levels that we don't usually get to. So all of this just says, we're at a place where we should bounce from, but it doesn't necessarily suggest that the pain is over. So here's the small caps, and again, we're at new 52-week lows on this small cap index. And looking down here on this thrust, we don't get down here very often, but we got down here in October of 2018, then rallied back, and the rally wasn't much, and then fell apart again. So anyway, an important place to keep in mind. So I think if you're going to be buying dips and trading and all that kind of stuff, I think you really need to be aware of how weak the market has become and how it might take more time to gain strength. Okay, one other thing that I want to show you is the McClellan Oscillator, and the reason I want to show you that is currently, this was yesterday's reading, down -127, but when we wind this chart out to 20 years, 127 is way down here. We had one reading in here in 2011 at 142. We had a reading in 2008 of 129 and a reading in 2001 of 120. So this is one of the most significant downward thrusts we've seen, and we're still at a very high level. We could fall a long way here on the summation index. So all of that leads us, so the McClellan Oscillator keeps track of the individual levels, but the summation index adds up the daily readings from the McClellan Oscillator. So we're still up at a very high level and could easily fall a lot more like we did in December of 2018. Anyway, that just suggests everything stretched to an extreme doesn't matter, could make a new extreme reading on everything. And obviously we're facing something that's very different than we faced before. So with that, let's move over to the companies and just update this and see if we've got anything more trying to spin positive, and we do. So let's go see what's going on the S&P. Okay, so the S&P is trying to rally here a little bit. Gold is absolutely let go. That's amazing. That is just a huge drop there. And then when we go look at the charts in the index here, all of a sudden these are starting to turn. It's interesting to see what's bouncing up the most. It's the cruise lines, and boy, talk about going right to the heart of the problem. So and energy, another name that's been beaten down. So here's Diamondback trying to bounce back up. Very interesting stuff. I think when let's just turn on a few columns here and sectors. Obviously, we're not going to have a whole bunch, but I'm just wondering if there's something we can here's NVIDIA up 2% today. But energy and discretionary, isn't that interesting how many discretionary stocks are trying to bounce? So obviously some people think they're very oversold, and this is a place to start farming. Wow, I'm impressed that they have that much moxie to go straight at those deep discount stock names. Let's just, I think what I'll do here. So in summary mode, again, if I wanted to control it and started to look through the stocks in this order, let's just go down to the very bottom, put number in sorted order on this chart list. And by doing so, I can look at them in the order that their current intraday price action is. And we're going to just take a few seconds here, go to 10 per page, and just see what's going down. So Norwegian Cruise Lines had broken through new 5-year lows. That's probably a good reason why somebody's starting to drill down there. And then here's Cimarex Energy. These energy names have just been beaten up. So a little bit of a bounce is nothing. I noticed Apache at one point was up 10% yesterday. Viacom, this one's another 52-week or 5-year low. Here's NVIDIA, somebody trying to buy it off the bounce, off the 50 or the 10-week moving average. That's held up really well. Look at the volume. That's the highest volume going back to February of last year. So NVIDIA is still holding up and people buying into that. Photonics, this one's very close to new 3-year lows. Royal Caribbean, obviously down and out. Concho Resources, very close to the lows in October. So that could be a double bottom here, potentially. I know the energy sector is really out of favor, but I think the biggest thing to be aware of is, what are people starting to look for, and they're trying to find value in those spaces. Here's travel, and I think that's a very gutsy buy, very early in a gutsy buy, in my opinion. PPO is just going below zero here, so for me that would be a watch closely. But again, we're trying to hold 3-year lows, and maybe that's the company buying their own stock. I don't know. But that, it just seems like travel is going to be subdued for a while with the airlines cutting routes and stuff. Here's FANG, Diamondback Energy. You can see this is new 4-year lows. So somebody trying to buy the dip there. The momentum trend is still down and out. If that trend line started to break, I'd start to be more interested in that. Discovery, this is new 52-week lows. And let's just go see what else we've got here. So here's Xilinx, and again, new 52-week lows on a semiconductor. That's not that great. You got a big downtrend in momentum here, but this one topped out in April of last year, so it wasn't one of the best semis holding up. Live Nation Entertainment, this one's breaking a 5-year upsloping trend line. Again, I think concert sales are going to have trouble if people don't want to go. Carnival Corporation, another one here in the cruise business, and obviously breaking to new at least 5-year lows. United Rentals, not sure why this one would be such a problem, but anyway, it's rolling over quite hard. Capri Holdings, again, down another 5-year low. That's not a surprise in retail, I don't think, to anybody. The hotel business, I would say that there's a big upslope that just got broken here on Marriott, and they did the merger with the Westin a few years ago. So that uptrend here looks under threat, and they were also just trying to break out through their previous 2-year consolidation, and as it broke out, it looks like this is a failed breakout and heading lower. So that is another area that I would be more cautious on. Here's another energy name way down in the bottom corner, Noble Energy. And Macy's, again, new 5-year low. So lots of things going on here. Here's Apache. And the one thing I did want to show on Apache was, again, while everything else is breaking down really, really hard, this stock actually had rallied back up yesterday. And today, this week, it's down 11% still. Everything is. But one of the things I liked was the previous price action on this stock and the way it was trying to wind higher. So thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesday and Friday at 10:30 a.m. Eastern Time. You can also catch the recordings on StockChartsTV YouTube page. And don't forget to check out the Canadian Technician on the StockCharts page. Thanks, everybody. Bye-bye.